A few weeks ago, I did a video explaining how the market cycle works and how every bull market begins with some kind of optimism around a certain theme or a certain thesis. And back in 2020, 2021, it was mainly electric vehicles, climate change, clean energy, stocks like Tesla and NIO. Everything got bet up to the stratosphere. And then they came back down in 2022. And from 2022 to early 2025, it has been mainly AI and anything around AI, semiconductor software, and Nvidia and Palantir and many stocks got bid up to the stratosphere, and they did go down in 2025. And I said after 2025, there will likely be something different. It's unlikely to be the AI software or mainly the AI chips or mainly something with EVs. It has to be something a little bit different. And I told you guys it will likely be robotics, anything around robotics, applications, and automations, and it could potentially be space stocks. And one of my favorite robotic stocks that I own in my portfolio, and I believe it's nearing a major inflection point, and this is Amazon, because Amazon very recently planned to deploy delivery robots inside Rivian van. This is going to be a game changer for a company like Amazon, because last mile delivery is Amazon's largest operating cost, making up over 50% of total shipping expenses. Replacing even a fraction of human drivers with humanoid robots could save billions and billions of dollars for a company like Amazon. This is something that no one has seen coming. I mean, just like Amazon Web Services, like no one have seen this coming, and everyone was just focused on the Amazon business. But now a lot of people are talking about robotics and Amazon's automation kind of business, and they have been by far one of the leaders in terms of automating warehouses, humanoids, robots, whatever you want to call them. They're very, very advanced compared to the competition. And if 50% of their cost is mainly on labor and they can save some of that, Amazon's margins will likely explode like never before. And the stock is still down 4% on the year. And I think it's looking very, very attractive. Now, I'm not going to go do a deep dive on Amazon's advertisement business and Amazon Web Services. Most of you guys know the whole story around them. So I'm trying to keep it short for you guys. And if I look at Amazon's price to operating cash flow, and we look at operating cash flow because CapEx is all over the place. So if you want to look at the profitability of the business, I think operating cash flow is an amazing way to do that. And the company right now is trading at 15 times price to operating cash flow, only 15 times with an average of 19. And the operating cash flow is growing 36%. It's likely going to grow 20% in 2025, then 23% in 2026. So it's massively, massively growing. And you're paying 15 times, which means you're paying less than 1 time price to operating cash flow growth for an amazing company like Amazon that's likely going to ride a massive tailwind in terms of humanoids, robotics, and automation in general. Now, I'm not saying that's going to happen tomorrow. It's going to happen this year. But if you're a long-term investor over the next 5 to 7 years, that could really help Amazon's efficiency and Amazon's margin in major way, and the company could do really, really well. Now, one of the downsides with investing in Amazon is their CapEx, and they keep pushing up CapEx to the stratosphere. It's one of the first companies in the world to spend $100 billion on just capital expenditures. No company has ever done something like what Amazon is doing. But this is a little bit bad, but I believe it's good because Amazon is still finding places to put the money to work. They're not doing buybacks. They're not doing dividends like a mature company, but instead they're reinvesting in themselves, building new warehouses, expanding their infrastructure, and just widening their moat in general, which I would personally prefer over a company that's doing buybacks and dividends, because that's likely a late stage company, and Amazon still has much longer runways than most people believe. So I like Amazon very much over here. I own the stock. I still don't believe it's too late to research the company and try to potentially open a position. I like it very much. One of my favorite mega cap stocks in my portfolio. And I'm going to talk about the second opportunity, which this one is a little bit mixed. It's not like the first one, not as good, but I believe it's presenting a good setup. And this is LVMH, ticker symbol LVMUY. This is an amazing company that's down 35% over the last year. The market's recovered, everything has recovered, everything has been going up, and LVMH keeps on going down. Now, a few weeks ago, back in April, I was a little bit bearish on LVMH, and I said there's so many better opportunities. And many people in the comments, they gave me a hard time, like they tried to call me out and take screenshots of when I said, LVMH was a buy at 120, now it's at 109, so I'm hating it, I should be loving it right now. The main reason I didn't love LVMH on April 15th was because Google was trading at 15 times, there was just so many better opportunities in general. So I compare LVMH and Amazon to other opportunities in the market. The company could be attractive, but if there's something more attractive, that makes this company unattractive to me. But if I look at LVMH right now, after the market has gone up and after everyone is euphoric, to me, on a relative basis, LVMH is looking very, very interesting. And LVMH owns many different companies that most of you guys know, and they even own stakes in the different companies. I'm not sure if they still have the stake in Hermes. I mean, they've been really killing LVMH on the high end, or you could say the luxury sector. It's not even close. The company is experiencing massive growth, and LVMH is, you could say, falling behind. But something that's very interesting about LVMH is the CEO, Bernard Arnault. He just keeps on buying the dip. Every single dip, he's been loading up on the stock like I've never seen before with a company of such scale. And very recently on May 8th, he purchased 5 billion euros, 15 billion, 14 billion, 9 billion, 14 million, 20, 99, 80, 126. This is massive, massive amounts of money that he's putting into LVMH, and now he owns pretty close to 49% of the company. I mean, this is a lot of skin in the game for a company like LVMH, and you don't find that very often. But the CEO clearly believes in the company. He's been buying the dip. So, I mean, this is a massive sign, and he has skin in the game. So this is one of the best setups you could have with an amazing company, especially like LVMH. Now, most of the company's revenues, they come either from Asia or from the United States. Now, Asia was in some kind of recession, especially in China. They weren't doing too well. The company was counting on the United States to take over the demand from China. That didn't really happen. United States is also struggling, and weirdly enough, it hasn't been doing too well. And Europe has been holding up the best, which is a little bit surprising because you'd have expected Asia to be holding up better, or maybe United States, but it's actually Europe. United States is down 3% organic, Japan 1%, Asia excluding Japan 11%, and Europe is up 2%, which was very surprising to me. And it's mainly a massive slowdown in demand after massive demand for luxury and high-end stuff over the last few years. But if you look at LVMH, and again, I talk about the setup in terms of risk versus reward, of the odds of something working, LVMH right now is trading at 19 times cash flow. What I like about FinChat is they give you the minimum and maximum lines. You could look at the ranges. And by the way, if you want access, they give you 2 weeks of free trial if you check out my link in the description. But LVMH at 19 times cash flow, the lowest was 17.7, very close to the low, and the highest was around 41 times. Now, if you look at this line over here, 19 times earnings has historically been some kind of a major bottom on a company like LVMH. And on this basis alone, in my opinion, it's looking very, very interesting. But if you look at the free cash flow yield, it's very close to the high end of 5.83%. Now it's at 5.17%. Again, very close to you could say, a historical bottom in a company like LVMH. So if you take in 5% on a free cash flow yield basis, and the company used to grow revenues 9%, 13%, 14%, 16%, occasionally 43 and 23. I mean, if they just grow 8% in revenues, and I'm getting a free cash flow yield of 5%, this is like a 13% annual return on LVMH if the margins remain in place, around 13% a year. But this is excluding a multiple normalization. So if the multiple gets back to the mean and interest rates starts coming down and the consumer feels confident again, then you could have much higher than a 13% return, closer to 15, 16, 17% return. And if you combine it with the CEO now buying massive amounts of stock. To me, LVMH is looking very interesting over here relative to other opportunities, but my favorite one again is still Amazon. I think Amazon is presenting an amazing setup. It doesn't mean the stock can't go lower on tariffs, but if you're a very long-term investor, there's so many call options with the company. Robots, they have something with space, they're launching satellites into space, they're doing all kinds of crazy things where if they do, it does pay off, it's going to be a game changer. So I like Amazon, love LVMH. That's just my opinion, not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.